What's up, guys? So, I'm about to go ahead and do a full breakdown of my trade on Bitcoin today. And I'm gonna kind of go over a little bit some of the indicators that I'm actually using so it all plays through to what I'm actually doing to get into these trades. So, I'm gonna just go ahead and delete most of this so you guys can see from start to finish how I'm looking at it. And like I said, just to give you guys a more thorough breakdown, but I'm gonna leave these up there. So this is Bitcoin. So I'm typically starting on the daily time frame. This is the daily time frame for me. So the first thing I'm looking at on today, this is price action for today. This bearish candle bar right here. And the first thing that I'm looking at is this month's monthly anchor VWAP. And I'm basically looking to see how price action is responding to this monthly anchor VWAP. So from January's this month's anchor VWAP, price action has pushed under it. So at this point, that's a confluence or an added probability into saying that price action could go in this direction. So the next thing that I'm looking at is December's monthly anchor VWAP to see how price action is responding to that one. Now the question that I know most of y'all, even though I haven't really fully in depth uh given out any like real educational material, or I haven't really gone in depth on my trading strategy with the education material yet. The main thing that I know that you guys are going to be asking is like, why is he placing so many anchor VWAPs? What's the reasoning behind it? What these anchor VWAPs do on, I guess, an intraday or like a same day perspective, it gives me a range to see where price action could go. Because more than likely, when price action, if you guys follow my cursor right here, when price action touches this anchor VWAP for X amount of reasons, price action decides to either reject from it, push from it, or break it and then continue in a different direction. So if you follow my cursor, I'm gonna minimize this, still on Bitcoin. If you follow December's anchor VWAP, price action basically hits it and rejects from it. And this entire time where price action is trying to move below, we do see price action break under this monthly anchor VWAP, but for the most part, it just consolidates or it just moves in a range around this anchor VWAP, which is, like I said earlier in my previous videos, it's like a moving average or an application that uh, basically goes through data, or it averages out a certain set of data over a period of time. So I don't need to do all of these complex algorithms or calculations to try and figure out, you know, where, or, behind all of these different reasonings of why price action did this at this price. So this is, like I said, this is all on the daily time frame. Price action touches December's anchor VWAP and it ranges and it pretty much continues to push up, comes back down to it, respects this anchor VWAP, ranges a little bit and pushes up every time. So when I did my own research into using these anchor VWAPs, which originally came from my first mentor, Austin, over at ASFX, uh, he more so introduced the idea of using the anchor VWAPs. And then for me on my own personal time, I was able to kind of create or generate my own strategy from that. But I got to give flowers where flowers are due. So that also adds in to another thing. Most of these concepts that some of these traders, especially me, that we come up with, it's not us reinventing the wheel. The only difference between how I get in my setups versus somebody else is just it all specifically comes down to what type of trader are you, you know, what's your tolerance, what's your risk, how much do you want to actually be in the markets, do you want to just trade on a day, or do you want to trade week by week or month by month? So it pretty much all narrows down to how you want to interpret the market. but then also does the way you interpret the market, does it actually achieve any type of results? Because yes, we're trying to make money, but also we want to make sure that we're doing this in a systematic approach. So back to it, going back to November's anchor VWAP. So now that I'm seeing that price action has pushed below December's anchor VWAP, it gives me a range to say, okay, be wary, or be alert to when price action touches its anchor VWAP. If you look closely, price action has already touched November's anchor VWAP, and you see what it did. It pretty much hit it, and now it's wicking from it. So that's a clear indication to me to say, if I didn't get into this trade before price action had hit this anchor VWAP, it's a clear indication to me to say, do you really think you should be in this trade? Do you really think that you should be risking money on this trade? Do you really want to start giving back your gains on these trades? So it's more so of a range for me. That's the reason why I mostly use monthly anchor VWAPs. So when I'm dropping down to the 15 minute, like I did earlier today, like I said, the first thing that I'm typically looking at are breaks of structure in the direction in which I want to get into a trade. So, reiteration of what I mean by breaks of structure, it means that at 3 a.m., which is London market open, I'm looking to see what happened during the Asian range. What is the Asian range? Between, I want to say, 6 p.m. when the market opens back up until about 3 a.m. market open. Now, a lot of people will say, the Asian range is a more specific range, but it keeps things simple for me, just so that I'm looking at price action, and anything before 3 a.m. when London market opens, this is the only price action that I will consider as the Asian range, because all I'm really worried about is the New York session. So I'm looking at the lows. Copy, paste. And most of these are presets that I have, so I don't have to like type most of this stuff out. So Asian range low and Asian range high. Now, for me, do I need to put Asian range high all the time? No, but this is just to help you guys to better look at the ranges in which I'm talking about. I don't care about using rectangles anymore. I care about the specific price, the specific low, and the specific high, and if price action can break that. So these are the two ranges that I'm looking at: Asian range low, Asian range high. Now, we get a bearish break of the Asian range low, so now it's moving in the direction from my bias from the daily time frame. If you guys rewind and go back to me explaining the daily time frame, it's moving in the direction, breaking major structural points. Why are these major structural points? Because they happen in a specific session. This is the Asian range, the Asian session, and this is the price action that happened within this session. Then the London session opened, and this is the specific range in which price action, these candle bars are moving. So pretty much after that, the next thing that I'm typically looking for, and this is a strategy that I picked up from ICT. It's using the fair value gap. Now, like I said before in previous videos, I don't trade the fair value gap as ICT trades it. I only like it because of the theory, and the theory supports why price action moves up or retraces back to a specific point in price, because price has these gaps, and more or less price has to fill these gaps, or to fulfill something within the actual order book, or these orders that come in and out the market, in order for price action to resume back in its direction. Like I said, that's just a theory. If you guys want to go into it more, I will recommend you guys go and look up ICT's fair value gaps to kind of understand it more. But this is the main reason why I use it. It adds another added probability, a more added confluence onto how I'm actually getting to my trades. So the next thing that I'm looking at after that is a major, I won't say a major red flag, but something that I definitely take as important is if price action ends up breaking, if this will let me do it, previous day's low. Now that's a major structural move because that was a low set from the previous day, not, lows that are set going in between the day, like the Asian range low, but it breaks a more major structural point set from a previous day. I don't have to reiterate that because daily highs and lows are more important than intraday or same day higher lows, but it's all varied on how price action decides to move for the day. And the only way I use, like I said, these structural high and lows is it gives me more added probability into getting into my trades. So after I see this major structural low get broken, I'm going down to the 1 minute. Now I'm gonna take that off right quick. So the main thing that I'm typically looking for is 1 minute divergence. And as I've explained in previous videos and other and different breakdowns, divergence for the new people is when price action continues to make higher highs, but yet on this RSI, it's making lower highs. So that means that price action is diverting. Now, does that mean that when price action does this, will it just always go down? Not at all. I've seen divergence pop up and price action will continue to go higher. Now, what gives me a more systematic approach into getting into my entries are using how I use breaks of structure on the 15 minute. I use breaks of structure on the 1 minute, but the way I do it is a little bit more nuanced. So the indicator that I use is called swing points. And I know this is going to kind of trip you guys up, but like I said, I'm going to explain a little bit better. So once I get divergence, the main thing that helps for me, so I don't have to use a lot of brain power, is looking for an ultimate lower low from the high of this divergence. And what this swing points indicator does for me, it just sets it as lower low, lower high, higher high. It just sets everything up for me. So now I don't have to, make the lines because it's my trigger entry, but I don't need to do all this extra process and brain power. It makes things a lot more easier for me to just get into my positions if I know what I'm looking for. So this is a recent addition. So the main thing I'm looking for from the 1 minute divergence high is for price action to move lower because that's the whole point. I want price action to move bearish. I want it to make a bearish move going down initially. Now the next thing that I'm looking for, you could say this the fill of these bearish fair value gaps or these bearish gaps in the market, but I kind of want to take your attention off of that because it's really just the breaks of structure that I'm really looking for. Next thing I'm looking for is a higher high, and then for price action to break this lower low straight down, coming through this price. And as you see, we get it. I pretty much get in on the close of this 1 minute, and the 1 minute time frame moves fairly quickly. So a lot of people, and I've had this happen to me a lot of times, is we'll wait almost until the candle close, and because the 1 minute moves so quickly, it'll print like the next bar pretty much. So you'll end up getting a couple of pips away, a couple of points away from where you're initially trying to get into. But as long as you know where price action is breaking structure and you can understand it, then it makes things a lot more easier. Now, the next place that I'm putting my stop loss is at this previous higher high. So it gives me room to breathe on my trade. And that's the main thing that I like to see is, do I have room to breathe? Do I have room to go in the drawdown? I basically go into the negative and at the same time, it allows price action to move in such a way so that buyers and sellers can get in, and then price action resumes in my direction.